This short tutorial provides an introduction to the topic of working capital. To understand the concept of working capital, we must consider the timing of cash inflows to a business and cash outflows from a business. This is called the cash conversion cycle. We'll consider the timing of cash flows in a company. We begin to measure time when raw materials are delivered to the company by a supplier. The raw materials are classified as inventory on the company balance sheet until the finished materials are sold to customers. This total period of time that the materials remain on the company inventory is referred to as the inventory days. Next, the finished materials are sold to the customer. If the customer does not pay the company immediately, then the customer is referred to as a debtor or as accounts receivable. The period from when the finished materials are sold to the customer and when the customer pays the company is referred to as debtor days. At the end of the debtor days period, cash is received from the customer. When raw materials were received from the supplier, the company did not pay the supplier immediately. Instead, the company received an invoice from the customer for the values of the raw materials. Following receipt of the raw materials, a period of time elapses before the company pays the supplier. This period of time is referred to as the creditor days. At the end of this period of time, the company pays cash to the supplier. Sometimes the cash is paid to suppliers before the cash is received from customers. Sometimes the cash is paid out to suppliers after the cash is received from customers. The cash conversion cycle formula is used to measure the difference in time between when cash is received from a customer and cash is paid to a supplier. The cash conversion cycle formula is stock days plus debtor days minus creditor days. When the company pays cash to the supplier before receiving cash from the customer, this formula gives a positive cash conversion cycle. When the company pays cash to the supplier after receiving cash from the customer, this formula gives a negative cash conversion cycle. This short tutorial provides an introduction to the topic of working capital.